Yeah, so super excited to be here with you today. So I have my buddy on the line as well, and this guy totally helped me out big time with some of my retirement accounts. And what I mean by that is I didn't even know that you could even invest in real estate with your retirement account um, until I had purchased a property here in Washington, D.C. And when I was purchasing the property in Washington, D.C., I was buying it from a custodian. And I had no idea what a custodian even meant. And then I started doing a little bit more research into it. I actually got under contract with the people. And then I met them in person right before we went to closing. And I'm like, wow, these guys are just like me. They're like my age. And they purchased this house in this account, this custodian account that ended up being their retirement account. And I'm like, wow, how did they get $600,000 to even purchase this property that I was then going to be buying from them for a profit for them, right? Like, how did they even get that much money into a retirement account? Because when you really think about a retirement account, that's something that the maximum the government even allows you to put into is like $18,000 to $19,000 or something like that, right? And then here they have $600,000 in it. And the reason they had $600,000 in it is because they had control over it. They had control over what they were going to invest in. They weren't just stuck to investing in the normal mutual funds that everybody else can invest in with the high fees, low returns, or mediocre returns. That's how they had $600,000 in it. And then when they sold that property to me, they made another couple $100,000 and didn't even have to pay taxes on it. So when I was talking to them and really started to get an understanding of this, I'm like, how do I get my retirement funds working for me and me driving the ship behind and selecting where this money gets deployed instead of just deploying it into any and every mutual fund out there? So and that's when I ran into my buddy Scott, and we have Scott here today. So Scott, if you don't mind sharing where you're from and what you do.
Sure. Thanks, Oliver, for the intro. Let me pull up my slides too as we're going through. Yeah, my name is Scott Maurer. I'm the business development director here for ADVANTA IRA. I'm just having trouble pulling up my where there it is. So what we do at ADVANTA IRA is we're a self-directed IRA administrator. And make sure are you doing the right screen? I'll make sure you have my full screen up.
I see your presenter slides. Yeah.
Gotcha. Okay. Hold on 1 second.
Cool.
There you go. Should see it now.
Yeah. Yep. That's
okay. Right. So my background, again, work for a company, ADVANTA IRA. We're a self-directed IRA administrator, which means we help people do exactly, Oliver, what you came in contact with, which is other individuals who have retirement accounts, who are looking to do something outside the stock market, outside the mutual fund market. They want that control. They want to be able to invest in things kind of, I would say, outside the norm, although I think the norm is certainly shifting, and probably not the norm within a group like this. Your norm is more of the real estate realm. But as far as when most people consider IRAs, 401ks, their mind generally will go to the stock market. And that's what those companies kind of want you to think, want you to believe. But there's so many different things that you can do with your retirement account. So just a little bit on my background. By degree, I'm an attorney, have a legal background, but I've been with ADVANTA now 15 years, actually 15 years this month. And I knew very little about self-directed IRAs when I started at ADVANTA. So it's been 15 years of learning. I learn new things every so often. It's a lot of what we do in our industry doesn't change a lot, but there's always unique situations. And that's always been what I think enticed me about this job is you always see different things. You meet new people, different people with different ideas and different things they want to invest in. And so being able to help those individuals out or being exposed to that has always been kind of a driver for me in this position. So but I've been with the company for 15 years. I spent a lot of the first probably 5 to 8 years helping people with the transaction. So, for instance, Oliver, in your situation, you had somebody who was selling a property to you using their IRA or using their 401k fund. I was on the custodian end, helping those individuals out through that process. Like I said, did that for 5 to 8 years, and did some marketing and some networking events during that time as well. But I've spent the last, 7 or so years focusing really on the business development for our company. Helping people learn more about self-directed IRAs, helping to drive our business and grow our business as well. We do have an office. Our main office is in the Tampa Bay area, where I'm calling you from today. We also have an office in Atlanta that we do sales and education, and we just placed an individual in Asheville, North Carolina as well. So
Yeah.
still looking to expand out a little bit.
And Scott, with you having offices in Florida, I live in Washington D.C. and I was still able to invest with you. So like, how do you normally handle how do you normally handle those situations when someone doesn't live in Florida or live in Atlanta or live in Asheville where you have an office?
Well, the great thing, obviously, with technology is you don't have to be able to drive to our office or come sit down in person. We deal with, documents through faxes, through DocuSign. It doesn't matter where a client is located. It doesn't matter where a property is located. The investment, we can work with anyone anywhere. We have quite a few clients. Actually, we have a number of clients up in the Virginia area. We have clients out in California, Texas, New York. And I don't like to say we have so many clients in all 50 states, because I don't know that that's true, but we definitely have clients in several different states. And it's because IRAs and 401ks are federally created entities. They're not state specific. So that's why we can work with anybody anywhere.
Right. Love that. Appreciate you sharing that.
Yep, no problem. As we go through the presentation, one thing I always have to share legally, just our disclaimer, and it's important to kind of note this too. I don't know how many people on the call have a self-directed IRA, have dealt with one before, but one thing that self-directed custodians don't do is we don't provide investment advice and we don't endorse any products. So you wanting to invest in a single family property, you want to invest in a multifamily syndication, make a private loan, whatever investment you're looking at doing through your account, our role is to process the paperwork, make sure it's properly titled, make sure you've approved the documents, make sure you're well aware of what's going on. But we're not actually looking at the investment itself and giving it a yay or nay and whether or not it's a good idea for you to make, or especially from a legal or tax perspective. That is completely up to you. Now, we can always refer you to CPAs, attorneys, advisors to help guide you a little bit, but we can't get into the realm of doing any particular advice. So I would just like to make sure that's clear. With the word self-directed, that's what it means. You're in control. You get credit for all the great decisions, and we don't take the blame for a bad decision if you make one. So it's completely up to you. That's what's very empowering, I think, for a lot of people. Oliver, that's something that you were talking about earlier as well.
Yeah, no, that's definitely the empowering part. I mean, that was like, for me, it was like, oh my God, I can take my money out of this highly volatile thing where like tomorrow it can go down to half or tomorrow it could go up, but it was always volatile. Like I always liked investing in real estate, something that was tangible, a hard asset, something that someone was paying me on a month basis. So when I found out that I could actually take my retirement accounts and my 401ks and like self-direct it, meaning I can select the investment vehicle that I want to use with it. Like I can say like, oh, I want to invest this in this multifamily syndication.
Yeah, actually, and we'll get into the motivators. I have a slide on the motivators in a second, but what you're hitting on is exactly what we've heard clients, like I said, I've been here 15 years. People have been saying those same kind of things to me all during that time that, you could invest in a stock today of a good company that everything sounds great until their earnings report comes out or their CEO's involved in some kind of scandal and they're in trouble. Next thing you know, that stock price is plummeting. Or geopolitical events happen across halfway across the globe that now are impacting your portfolio, as opposed to I can buy a property down the street from me. I can see it, I can touch it. I know the kind of people that rent in this area. I know what the rents go for. And for those individuals, that's why, especially, I mean, we do a lot of things other than real estate as well, but real estate's really the primary asset we hold for our clients. And that's why, because it's tangible, because you can see it, because you have more control over it. As you said, it offers kind of the two ways to earn. You got the appreciation if you buy the property at the right price. You sell it years later, you have that appreciation, but hopefully you also have a nice cash flow component in the interim as well.
Yeah, totally agree.
Yep. Just a little bit about our company. We've been around for almost 20 years. We have over $1.5 billion assets under management for our clients. We have about 76 or 7,700 active clients between our Tampa and our Atlanta office. What we do at ADVANTA that's a little bit different from other companies is that we really are dedicated on two fronts. We commit to education. That's kind of what I'm doing today. We enjoy getting out and talking with individuals, whether it's our own event, whether we're being invited to come on and speak with somebody else, to give that education, but also on the really on the customer service side of things, giving everybody kind of a concierge level of service regarding the account. It's not an 800 number you call into when you have a question. You call your actual account manager at ADVANTA IRA directly. So kind of jump into some of the presentation here. And for those of you on the call or watching on Facebook, we don't know what a self-directed IRA is. We've kind of already started touching on it this morning, but it's an account which gives you complete control over the investments that you wish to make inside of your account, not being limited to what your bank or brokerage firm. You have an IRA, or you have a 401k with those entities, they're going to limit you to investing in what they sell. So a self-directed IRA is going beyond those particular investments and investing in things that the IRS is happy to let you invest in, but not every custodian is willing to hold. So again, as Oliver, you mentioned, people like the fact that it's tangible, it's different, it's diverse. You get your money out of the stock market into something else. And so whether it's real estate, mortgages, private placements, metals, currency, we've seen people in big interest right now with cryptocurrency, with Bitcoin going up, people looking to put that in their IRA. Again, the key thing all those assets have in common is simply that brokerage firms typically won't hold those, and that's what people are looking to invest in, with the self-directed IRA. And most people haven't heard of a self-directed IRA, again, because they have their IRA with a bank, with a brokerage firm, or they work for a company that has a 401k, and that's where your assets are held. So you don't really know any different because your account's at Fidelity and they don't offer you to invest in, they don't do webinars on investing in a single family home or a multifamily syndication. So you kind of have to look beyond that. Again, the IRS regulations, and I'll touch on some of the rules briefly a little bit later. IRS regulations allow you to do so many different things. Only a couple things that you can't do within your retirement account when it comes to investing. So, but again, it's up to each custodian on what they're willing to hold. And again, what we're different at ADVANTA is that we will hold basically anything that's not publicly traded. So we're not a brokerage firm, so we don't deal with stocks, bonds, mutual funds. We deal with kind of that other realm of really anything under the sea that's permitted by the IRS code. So again, a lot of that is real estate.
Real quick, you said custodian, right? So just so that we can kind of dig into that a little bit. That's so I would have my investment, our retirement account is with ADVANTA IRA, which is the custodian over that account.
Correct.
Right. And then can you just explain like what the custodian does? They're almost like the person that helps direct that, right?
Yeah. So the custodian, so when you have an IRA account, the rules that are set out for IRAs is you have to have your money held and your assets held by a custodian. You can't simply go to down to a bank and open up a bank account and say, hey, this is my IRA, and just name it that way. You have to have somebody actually acting as custodian. The custodian performs the work to hold the assets, and also, more importantly, to do all of the IRS reporting that goes along with that account. So for your IRA,
too, Scott, when you say hold the assets, they're not being held there. You guys are just doing like all the reporting, so you guys create all the statements, right?
Correct.
Okay.
Correct. Yeah. So we're doing the statements. We're doing the reporting to the IRS. Whenever you make a contribution, you take a distribution, we report the annual value as required. So that's what the custodian is doing. And in general, we'll get into, again, the case studies to show you how it's titled. We hold title to the assets with the IRAs. For instance, if you're buying a piece of real estate in your IRA, it's not, Joe Smith on title, it's ADVANTA for benefit of Joe Smith's IRA. And that what that does is demonstrate to the IRS that property, that asset is held in the name of your IRA, and therefore that signals to the IRS that there's not going to be any tax repercussions for investing in that particular asset, right, and the gains that come from it.
Right, which is huge. You know what I mean? All of a sudden, you make $100,000 gain on a property, you make $1 million gain. You're not paying any taxes on that gain. You're now rolling it over into the next investment, and you can grow your portfolio at an exponential rate versus if you were paying taxes every time you exited an investment.
Right, that's really the benefit that IRAs in general have. They're taxed. They were they're created. We'll go over some of the different ones here on this slide in a second, but the government created IRAs to encourage people to save for their own retirement accounts. They knew when they created these back in 1970s, they were already saying, hey, we're going to have an issue. If everybody is waiting on Social Security or the government for, retirement account, for their retirement income, that's going to be a problem. So they created IRAs, they created 401ks to encourage people to save for themselves. And the way the government encourages behavior is through tax benefits. So whether you get a tax deduction for your contribution, or more importantly, Oliver, as you just said, the ability to not have to pay taxes as you go along. So as you say, as you make a profit on a piece of real estate, within an IRA, you don't pay taxes. Or if you sell a stock, you don't pay taxes at the sale. You're only going to pay taxes down the line with regular IRA accounts when you retire. And so you get the benefit of tax deferral for the entirety of your account, which allows you to compound your money much more quickly. And again, that's the behavior the IRS wants you to. They encourage your behavior through tax benefits, and using your IRA in that fashion allows you just to compound your money much more quickly than, if you're right, if you had to pay taxes or capital gains or ordinary income every time you sold a property or had any income, it's taking that much longer to build your funds. That's why 1031s exist as well.
Right.
Again, so.
Yeah, because if you think about it, if you're at a 35% tax bracket, that's 35% of that gain that now you're paying to pay taxes instead of continuing to multiply that big egg. And
Absolutely.
then Garth actually had a question. He said, "Are you allowed to take some of those gains and roll it into a traditional IRA or 401k without the same penalty?" So I think, Garth, what we want to make sure we clarify there is that when you're investing with your IRA, it's got to be completely the IRA's money. So everything's got to stay in there as well.
Yep. Yeah. That's very true. And I don't know if he's getting at too. If you're investing personally and you have personal gains, you make money on a deal. I don't know if he's alluding to that, then putting some of those gains into the IRA. Now there are ways to structure your real estate business. Structure yourself as a business where maybe some of those profits from your business can be contributed to either, as you can see on this screen, either a SEP IRA or perhaps an individual or solo 401k plan. But if you are investing with your IRA, so your IRA is actually making the investment, then the gains from that investment automatically flow back to your account with no tax consequence. So again, as you can see on this screen, there are kind of the different accounts out there that can be self-directed include every type of IRA, your traditional and your Roth accounts, which are more kind of individual IRA accounts. Then there's also the SEP and the Simple, which are for small business owners, or again, if somebody's on the call here is self-employed. SEPs and Simple simply allow for a larger contribution on an annual basis. Now, the difference between the traditional and the Roth is the tax treatment. The traditional IRA, you make contributions to that account. You get a tax deduction up front that year you make the contribution, so you save a little bit on your taxes now. The money grows tax deferred, but when you get to retirement age and pull that money out, it's taxed to you at ordinary income at that time. So you still get the benefit of the tax deferral and you get the upfront deduction. The Roth IRA works the reverse of that, and that you do not get a deduction up front when you contribute to a Roth IRA. But the benefit, a huge benefit that the Roth has, is you get that same tax deferral through the course of as you're investing and reinvesting. When you get to retirement age with a Roth IRA, the income comes out completely tax-free. So that's why a Roth IRA is usually a lot of people are big proponents of Roth IRAs because of simply knowing that money in that account is growing completely tax-free.
Yeah, that's super powerful. And then Matt had a question. He said, can you do a backdoor Roth conversion with a self-directed IRA?
You can. Yep.
Okay.
So
can you actually explain what a backdoor is? Because I didn't even know. I didn't even know what a backdoor.
Absolutely. So with Roth IRAs, in order to contribute, just take money out of your pocket and put it in that $6,000 a year into a Roth IRA, you have to actually have income below certain thresholds. I think for a single individual, it's usually around 125, 130 grand a year. If you make more than that, you cannot contribute directly to a Roth IRA account. So the IRS says, sorry, almost like you're making too much money. You can't make that contribution. The traditional IRA does not have that same restriction. So anybody, regardless of income, can contribute to a traditional IRA. The IRS also will allow you, if you have money in a traditional IRA, to do what's called a conversion to a Roth IRA, which is taking money from the pre-tax bucket of the traditional IRA and moving it to the Roth. And what happens when you do that is you get a 1099 that year for whatever amount you move from the traditional to the Roth. You will pay taxes on it that year. So if I convert, say, 20 grand from my traditional to my Roth here in 2021, next April when I'm doing my taxes, I have to include that 20,000 of income. But the benefit is once I get that money moved into the Roth, it's now growing tax-free. So what a backdoor Roth contribution is, or conversion is making the contribution to the traditional IRA because there's no restriction on it. And then there's also no restriction on doing a conversion back to a Roth. So it's a way to get around the rule of not being allowed to contribute directly to a Roth. So you can do that in any type of IRA, self-directed, brokerage account, it doesn't matter.
So to dig a little bit deeper into that, Scott, if you have a 401k that was filled of money that was pre-tax, when you convert that to a Roth IRA or a Roth IRA, then that would be a taxable event.
Correct.
And you'd have to pay your whatever your income, whatever tax bracket you're in right now. That's the tax liability you would owe.
Pretty much. I mean, it's included in your income, so it can actually bump you up tax brackets depending on all your other income. For individuals who are having, they have a lot of tax write-offs. Maybe you started a new business, you have other write-offs. You may be able to make a contribution and pay a lot less in tax because your write-offs you're impacting your overall tax bill. So it's basically take the amount you convert and just lump it on top of your other income, and that's going to be how it gets figured out. So if you do have losses in a given year, that can be a reason to convert to a Roth IRA account.
Okay. And then the Roth, just so we're clear, when you have the Roth IRA, you still can't access that money until you are retired?
Correct. With all the retirement accounts on this screen, I mean, you have to be over the age of 59 and a half to take the money back out without any penalty. So if you take out money prior to 59 and a half, there's a 10% penalty that you get hit with, in addition to income tax with the traditional IRAs, the SEPs, the Simples, and some of the 401ks. The Roth IRA, again, ultimately that income is going to be tax-free. So the government says, here's some great tax benefits. We want you to put the money into the IRA, but we want you to leave it in the account until you get on later in life, so that they don't want you to they don't want to give you the tax benefits and have you turn around and take the money back out the next day. So there is a penalty of 10% of the amount you withdraw if you're under age 59 and a half. So again, any type of IRA can be self-directed. If you are self-employed, one of the popular accounts that people will open and look into is an individual or solo 401k plan. That's, again, definitely something to run by your CPA. That allows you to contribute close to $58,000 a year by doing a solo 401k plan. So again, if you're looking to really maximize how much money you could put into an account during a given year, the solo 401k gives you the biggest bang for your buck. And again, that can be also a large tax deduction for you as well. The other accounts I think people miss a lot of times when they hear self-directed IRAs are those former employer plans. If someone works for a company that has an old 401k, an old 403b plan, once you're no longer employed with those companies, you can roll that money into a traditional IRA with no tax consequence at all, and just roll it right on over, and then begin investing in a self-directed capacity. So as long as you're employed, though, with a company or an entity, they can restrict your ability to move that money around. So that's the only caveat to self-directed IRAs, and the accounts are current employer plans that will place some of those restrictions out there.
When you say restrictions, will some employers allow you to move that money, or is it up to their decision to select, say whether you can move it or you can't move it?
It is. So when they create the 401k plan, they can write some of the rules differently on how they will allow you to move the money. Most of them, what happens kind of behind the scenes is a company wants to do a 401k plan for its employees. and they go to a Fidelity or a Charles Schwab and say, hey, we want to do a 401k plan for all of our employees. Now, Schwab and Fidelity will basically give them probably breaks and benefit on their fees that they would charge if they agree to have all of the clients and all of the investors, employees, have only access to, say, Fidelity assets or Schwab assets. So that's why a lot of plans are limited, is because those firms have arrangements with the employer where they're not going to allow you to move money out while someone's still employed. That being said, I always encourage people to go ahead and call and ask, because some plans are written differently. Some plans allow for rollovers prior to 59 and a half. It always kind of surprises me. Somebody will ask and say, I have a current plan, and they call up and say, hey, yeah, I'm allowed to take a certain percentage or a certain amount of that money and roll it out. Now, once you're over 59 and a half, even if you're still employed there, almost all plans at that point will allow you to roll over to an IRA account. So again, something to consider if someone's over 59 and a half, current employer plans, you can still roll that money out to an IRA. We talked earlier kind of about motivations. Why do people choose to self-direct? Why, a lot of you listening to this call, and the people we've dealt with over the year, why are people saying, hey, I want to self-direct these funds and self-direct my 401k? I think in the middle box there, a lot of it has stemmed over the years. We've certainly heard it from stock market fatigue, the ups and downs of a market, again, where you have no control over that. I mean, you can buy and sell your mutual funds, but if you're trying to time the market, trying to pick the winner among a group of stocks, a lot of people just don't get it. They don't understand it. And they get tired of, again, you put money into this account. Hey, it went up this year. That's great. Then something happens that you can't, out of your control, either with the government, with countries around the world. And next thing you know, your 401k, your IRA is headed back down again. So again, it's pulling the money out and putting it into something that you can see, you can touch, and get it out of the market. For some clients, it's the tax benefits. As we're talking again, as you invest and reinvest, you do not pay any taxes on that money coming back into the IRA account. So that's one of the huge benefits if you're buying and selling, flipping houses, getting good returns. You're not going to have any tax impact to you because this is all going back into your IRA account. But really, for a large amount of our clients, one of the main drivers is simply that this is a new source of capital. A lot of our clients are real estate investors before they come to us. This is not something where, and we definitely have people who come to us and buying their first rental property through their IRA account. That definitely happens. But a lot of people already are investing or have invested in the past in similar assets. They already buy rental properties. They already invest in private syndications. And the IRA is simply providing them another sack of money to use to make that investment. So it's basically the cash in their retirement account is giving them, this deal. So come across a deal, I need $50,000. I could pull it from my personal savings account and deplete that and lock it up, or I could just use my IRA to do it. And I wasn't planning on touching that money anyway for several years. So that's, again, some of the main reasons I think why people have chosen to self-direct over the years, at least what we've heard from our clients.
Yeah, for me personally, Scott, I had definitely had that stock market fatigue. I'm busy out there running my business, and then obviously I have my real estate, and I always found myself my attention was on my retirement account. Is it going down? Is it going down? How's it being impacted by the stocks? And it was just let me just get that money out of there so I can keep my attention moving forward on what I'm really good at. And then I could invest it alongside of the other awesome things that I was already doing in real estate. So it was it allowed me to focus my attention on where I wanted to go instead of constantly worrying, is it going up? Is it going down?
Yeah, and again, a stockbroker is probably not going to choose real estate as his investment for his 401k, right? Because his knowledge base is in the market and reading market trends. But for people who invest in real estate, and even some of the general public, real estate's a simpler concept to understand, or maybe they have, that's where their expertise is. So why wouldn't you invest your funds into something you understand much more than the stock market? And I think that's right what you were getting at, Oliver, is, I have the money in the market. It's going up and down. I'm not sure why, but I know that if I buy this rental property down the street in my neighborhood, that I can get, $2,000 a month for rent. I know the expenses are low. I know the fees are low, and I know I could keep this property rented almost 100% of the time because it's a good neighborhood, good property. And therefore I almost know what my returns are going to be. And I'm not going to have to worry, even if the market dips a little bit, I'm still going to be able to rent the property. Maybe my rent value may ebb and flow, but I'm going to be still getting a consistent return. And over the long haul, real estate's always been a really good play in general.
Yeah. Scott, we did have a question that came in. Perry's asking, my understanding is with the Roth, you can't take out what you put in, but can't put it back, meaning if you hit the limit doesn't reset. Do you get what he means?
I'm not sure. Well, one thing with the Roth IRA that's unique, I didn't go into it because it's a little bit more, you kind of go down a little bit of a rabbit hole with it, but with a Roth IRA, anything that you contribute to a Roth, so if I'm eligible to contribute this year to a Roth and I put in $6,000, and last year I put in $6,000 and my account's growing, I can always pull out what I've contributed tax and penalty free. So in theory, I could put in $6,000 in January into my Roth IRA. By the end of the year, I've grown that account to say $10,000. I could pull my original $6,000 out without penalty and without taxes and leave my $4,000 of earnings in that account. So it's kind of a unique rule on how the Roth works. That does not happen with any other type of IRA. It's only the Roth where you can pull out any amount that you've contributed over the years, tax and penalty free. But when you start touching the earnings in the account is when you're subject to that 10% penalty. I think that might have been what he was getting at. So with real estate, again, real estate's probably 70 to 75% of the assets that we hold at ADVANTA. That can be anything from people doing rental properties to joint ventures to syndications, doing options, people doing tax deeds and tax liens, private lending. We've had some people wholesale. So really, whatever your kind of specialty is, whatever your preference is for investing in real estate, you can do it and make that type of an investment within a self-directed IRA.
Yeah, that's pretty cool. I'm glad Perry asked that question because I didn't even realize that about the Roth. So that's cool.
Yeah, it's
down the rabbit hole, but I got a little golden nugget out of that one.
Yep. That's a unique feature of the Roth for sure. So, one question we get a lot, I think, when people are looking to open up an account and move money from their current custodian, their current IRA over to ADVANTA or an old 401k is, how do I do it and what kind of penalties or taxes are involved? Because a lot of advisors, if you went to your advisor and says, hey, I need to invest my IRA into real estate, they'll be like, oh, well, if you're going to do that, you got to pull your money out. There's a 10% penalty because you're under 59.5 and you have all this taxes you have to worry about. And so I think some people out there probably don't self-direct for that reason because they get some bad advice and some bad information right up front. If you ever want to move money between IRAs or from an old 401k to an IRA, you can do so tax-free. It's a very simple process by either doing a transfer or a direct rollover. The only difference is kind of on what accounts are involved. So a transfer is moving money directly from one IRA to another IRA. So you can move money from Fidelity to Schwab, Schwab to ADVANTA, ADVANTA to TD Ameritrade. As long as you never touch those funds, it's a tax-free movement of money, and you can do that as often and whenever you'd like to get that money moved from one custodian to another. Direct rollover is simply you have that old 401k, 403b, and those employer plans, doing a rollover from that account to an IRA. Again, as long as you don't touch the money and it goes from one custodian directly to the other, it is a non-taxable event. And you can do them, again, as often as you'd like, and you can do them in whatever amounts that you like. So we have a lot of clients who might have $200,000 or $300,000 in their IRA at a brokerage house, and they need, say, $100,000 to invest in a syndication. So they transfer over just the $100,000 they need for the syndication. They leave the rest of the money where it's at. They come across another deal. They move another $100,000 over to take advantage of a second investment. You're permitted to do that, again, as often and whenever you like. As long as there are forms going back and forth and you're not touching the money, there are no tax consequences, no penalties. And that's something in ADVANTA we do at kind of the upfront part of the process with you is, when you're opening up the account, is where are your funds? How much are you looking to move over? Let's make sure we get the right paperwork in order. And again, a lot of advisors, because they grow up in the world, or I don't say grow up, but their professional career is built around buying and selling mutual funds and stocks. A lot of advisors have no idea that this is even possible. It's becoming a little bit more well-known, but some advisors don't even know it's possible. So they think when you say, I want to use my IRA to invest in real estate, they think you're taking the money out personally as a distribution and then going and buying the property, which would indeed be subject to penalties and tax. But when you're moving it to a self-directed IRA, it's never leaving that tax protection that the IRA provides. So there's no impact to you personally, and you have that whole amount of capital to use going forward.
That's a really good distinction there, Scott. And I'm glad you brought that to everyone's attention, because that, most people are scared because they think they're going to have to pay the penalty and the tax due. But no, when you have it in a self-directed, you can actually invest in these real estate deals and not have to pay those penalties. Because you're investing in the IRA.
Absolutely.
It has to be set up properly to be able to invest your IRA resources into the real estate deal. And
Yeah,
then
I think
you can.
No, I was going to say one thing I think is important, kind of conceptually, how I got it way back in the day when I was first learning. People, if you said I'm moving money from a Fidelity IRA to a Schwab IRA, you wouldn't even think about the tax consequence, right? 'Cause I'm buying these mutual funds, I'm going over here to buy different mutual funds. The IRS doesn't look at real estate, mutual funds, stocks, private loans. Those are just the investments inside the account. So it doesn't make any difference to the IRS what asset is held under the account. They just want the money moved back and forth. So you wouldn't expect to pay taxes moving money from Fidelity to Schwab. You shouldn't expect to pay taxes moving it from Fidelity to ADVANTA, because it's still going IRA to IRA. As long as that's happening, it doesn't matter what the underlying investment is. And that's something I think where people do get hung up on. And again, I think that's where some advisors, they're not doing it intentionally. They just don't think that's possible because they don't even know that this exists.
Yeah. And then one more thing, Scott, Garth had a question. He said, can you roll over old 401ks or existing ones as well?
Old 401ks, absolutely, 100%. You can move an old plan over. With a current plan, you do have to call the administrator and ask what your options are. And I typically advise people, if it's a current plan, just call up and say, I'd like to roll some of this money to an IRA. What do I need to do? And they'll either tell you, hey, fill out this form, or they'll say, hey, your plan does not allow for what's called an in-service rollover. So it's a rollover that you're still working there, you're in service. A lot of companies do not allow for in-service rollovers. But again, some of them do, or some of them allow you to take certain amounts of funds from those accounts and roll them over. So it's always worth the question for a current custodian, at least to ask. But any former plan, it's just a matter of filling out the paperwork to move the money. They can't restrict you from moving the funds.
Cool. And then I don't know if you're going to hit this later, but Brian asked, I've heard that leveraged gains, which means you have your 401k dollars, and then you also have a loan on the property, right? Leveraged gains will become taxable under certain scenarios. Is that true? And if it is true, is there any way to avoid that?
So that keys up our next slide, because that's right here on our next slide. That's a great question. I'll get to that in just a second.
Okay.
So I mentioned the IRS rules for investing. You can invest in so many different things. Obviously the conventional assets, the alternative assets we're talking about today. And the IRS rules for investing, there's only a couple things that you can't do, and then there's a couple instances where tax can apply, like we're just being asked. So the only investments you can't buy within an IRA account are life insurance and collectibles. Is the only two prohibited investments underneath the IRS rules. So the IRS code section does not list all of the possible investments. It simply says you can't buy life insurance and you can't buy collectibles. And collectibles are your antiques, your vintage wines, artwork, things like that.
Why can't you buy collectibles? Is it because maybe you can use them, or
Yeah, that's definitely one of the reasons. So yeah, if I bought a Monet in my IRA account and it's hanging in my living room, I'm getting the same benefit out of it, and I'm getting the tax benefit. And the IRS doesn't want you as a disqualified person, which leads into the next rule. They don't want you as a disqualified person to also be getting a current benefit from it. Okay. The other area, I think the reason why is because sometimes collectibles are difficult to value. The distributions you take later in life, when you get to age 72 and you have to start taking distributions, other than a Roth IRA, which is you don't have to take them, but regular IRAs, you have to take a distribution starting at age 72. It's based on the value of the account. So I think that valuation comes into play. And everyone on this call, you could put up a masterpiece painting in front of us, and we'd probably all come up with different amounts we'd be willing to pay for it. Some of us might pay $1 million plus, others of us wouldn't spend $10 on it. So the valuation is a little bit more it's not as, there's not as much of a market like there is for, say, real estate or for stocks and bonds. So I think that's one of the reasons collectibles are also prohibited. But I think the personal use is probably the primary reason.
Awesome.
So you can't buy life insurance, you can't buy collectibles, and your IRA also cannot transact with a disqualified person, and your IRA or you as the owner or a disqualified person cannot get a benefit from the assets of the plan. I'm going to jump forward one slide, then I'm going to jump back for the UDFI rules. So the disqualified persons for your IRA account include you as the IRA owner and your spouse, your parents and grandparents, and your children and grandchildren, and then any entity that is owned or controlled by one of these individuals. So within the IRS rules, your IRA as its own legal entity cannot cannot transact with these people, and none of these individuals can get a benefit from the investment. So in real estate realm, the simplest example is you can't use your IRA to buy a vacation home or a primary residence that you or one of these individuals is going to be using part of the time and getting a current benefit from. So it kind of almost gets back to the collectibles thing we were talking again. You're not allowed to also be getting a current benefit from it. You also can't buy or sell anything that you already own to your IRA or from your IRA. So you're right. If you have a rental property already personally, you can't simply sell it to your IRA, even for a fair market value. It's simply not permitted under the IRS rules. So they call it kind of self-dealing. So again, that's the one area that does come up a lot when we're talking about real estate, is assets that people already own or already have an interest in. Those are pretty much off limits for doing so. So those are only things that are prohibited: the life insurance, collectibles, and in dealing with a disqualified person. Now, the question came up just a minute ago about UBIT and UDFI tax. So for the most part, when your IRA is making investments, the income that it generates simply comes back to the IRA with no tax consequence to you, certainly, and no tax consequence to the IRA account. But there are two instances in which an IRA can be subject to its own tax based on the income it gets. So it's important to note, as we get into talking about UBIT and UDFI, that if these taxes apply, it applies to your IRA, not to you personally. So these taxes don't show up anywhere on your personal tax return. But the only two instances in which an IRA can be subject to a tax are if it's engaged in business activity. So your IRA is in receipt of business income, not investment income. Simple example, your IRA invests into a local restaurant, and at the end of the month, your IRA gets a percentage of the overall business profits. What the net profit is at the end of the day. That's business income to your IRA. That's subject to UBIT. It's called unrelated business income tax. Investing in companies like Coca-Cola, IBM, where you get a dividend back each month. A dividend is investment income. That's why you don't pay UBIT tax on your kind of more traditional stock or mutual fund investments. But when it comes to real estate, the other area where the IRA can be subject to a tax is in the area of unrelated debt financed income. So if your IRA buys a property and pays all cash with no leverage involved, there's no UDFI tax. There is no leverage. But if you do have a situation where your IRA makes a down payment, borrows the rest of the funds for the purchase, your IRA can then be subject to this unrelated debt financed income tax. Or if your IRA invests into maybe even a real estate syndication that has underlying leverage, your IRA can be subject to UDFI. Now, how UDFI typically works is if I put down, let's say I put down 30% on a property and I borrow the other 70%, that means that the property is 70% leveraged, and 70% of the income that my IRA receives is going to be subject to that tax. Now, my IRA at that point can take deductions and depreciation to offset that tax as well. So my IRA could take 70% of any available deductions or depreciation to limit how much tax my IRA would actually pay. So again, it's important to note with these taxes, again, this does not make the investment prohibited at all. You can still 100% make the investment. You just have to factor in this tax, obviously, to what your overall return is. One other key caveat for those on the call, again, if you're self-employed individual and you can set up a solo 401k plan. Solo 401k plans do not pay UDFI tax. So you could do the same investment with an IRA, be subject to UDFI, do the exact same investment with a solo 401k and not have to worry about this tax at all.
Right. So that's what I've always been used to, is like the solo 401k. Now, when you said the solo 401k, can multiple people be in that umbrella, or it's a one person?
So for a solo 401k, you cannot have any employees of the business outside of like your family members. So if it's like a husband and wife own a business together, you can still have a solo 401k as long as you don't have any other employees in that business. That's at least for the solo. Okay. Now, if you can certainly have a 401k with employees, you just have to have a different type of administrator involved who's going to properly test the plan and make sure everybody's being treated fairly. But solo Ks could be two business partners. Again, as long as you don't have any common law employees, other than the owners or certain family members, you can have a solo K.
Awesome. Appreciate you going into deep detail on that.
Yep. And so, yeah, the UDFI, I kind of gave it, I went a little bit of a discussion there on it. It definitely goes deeper than that. It's a little more complicated issue to understand. Just know that, if you're invested into a business, you could have it, or if you're invested into leverage real estate, it's something to consider. Again, all it does is mean your IRA might have to pay a tax, and you get other deductions and write-offs to limit that. All right, so we covered disqualified persons. Again, so before I'm about to go into kind of some case studies, again, just illustrating the real estate assets. Again, whatever your preferences, whatever your specialty is in investing in real estate, you can do it within an IRA account. Again, as long as you're not buying from yourself, selling to yourself, or buying a project that you're going to manage and take a fee from, which would involve a prohibited transaction. If it's just a passive deal and you're buying and selling from third parties, you're renting to third parties, there's really no limit on what you can do in the real estate realm. Again, we have clients. We've been around since 2004. We have clients that bought real estate in 2004, still hold that same property today. Long-term rental. You can do short-term rentals. I'm sorry.
If that person's the operator, does that have any effect on it, or do they have to be like just a passive investor in the deal?
So we'll get into a little bit. If I'm buying a rental property through my IRA account, the way we interpret the rules, you could still, be choosing your tenant, deciding what work needs to be done, calling the plumber, calling the electrician, but you're prohibited from doing the work yourself, and you're prohibited from being compensated, certainly, for doing any work as well. So a lot of our clients do own the property. It's passive in the sense that they're not being paid and they're not doing the work, but they're still involved kind of in managing and overseeing the asset itself.
Got it. So you can't, if you're trying to get windows replaced or change the flooring, you can't go in there and do all that flooring work yourself. You have to pay a contractor to do that if you're going to invest with your retirement account.
That is correct. Yes.
Okay.
Yep.
Cool. Got it.
Yep. So when it comes to rehab projects, your IRA can go buy a fixer-upper, but you're going to be hiring all the contractors to do the work. I've had people who are contractors say, "Hey, I'm buying this. What can I do?" Like, well, you need to have your IRA pay all your subcontractors. You can't pay them and have the IRA then reimburse you. That's, that would be prohibited. So there's definitely some little things with the rules that you have to be a little careful of regarding how involved you want to get. But we can kind of switch gears. I don't know if we have any questions before we get into the case studies, but I can kind of jump into those too. I have a kind of go over 3 different ways people invest in real estate. Again, there's so many more different ways, but these are kind of our simple examples. Rental properties, we'll do a rental property example, a joint venture deal, and kind of a multifamily deal, and illustrate kind of how it works and what roles we play and what roles the client plays in that overall process.
Love it. Yeah, I've been asking you the questions that they've been coming in, so we're good to roll.
Okay, good deal. So our first case study is, I would say, kind of like a bread and butter thing we see people do all day long at ADVANTA. That's just, hey, I got money in my IRA, my old 401k, and I just want to buy a rental property. 3-2, 2-1, whatever, rental property down the street. So in this case study, we had John, a client of ours, had 150 grand in an old 401k. There's a property was down the street from him, get for about $100,000. So kind of who does what in the process. When you're doing a self-directed IRA, in this case, John, as the account owner, needs to open up and fund his account. So he's going to fill out paperwork with us to establish the IRA, give us his beneficiary designations, tell us where his funds are currently held, and then get that money moved over into the account. As I mentioned at the very beginning, John's the one finding the investment property. We are not suggesting investments to him. We're not evaluating the property. It's going to be up to him to find the property and then make the offer to purchase. So when he makes the offer, it's going to be, again, his IRA is actually going to be the entity on title on the contract. He'll send that contract to us for us to go ahead and sign. And he's going to ultimately read and approve. It says they'll type it. They're not all loan documents, all closing documents. So what our role is at ADVANTA, we're going to help John get the account opened. And when he tells us he's buying this property down the street, we're going to want to see that the contract and then all of the closing documents, the deed, the settlement statement, the title insurance, all of that's going to need to reflect John's IRA account as the actual owner. So instead of the buyer being, say, John Smith, the buyer is going to need to read ADVANTA IRA for benefit of John Smith's IRA account. So again, demonstrating to the IRS that this is an IRA-owned asset. There's no tax consequence at the purchase. There's no tax consequence for the cash flow that's going to come back in to his account. So we will actually be working with the closing agent to make sure all of that titling is on the documents. And then once we've reviewed it and said, yep, all the titling is correct, we shoot it back over to John. John reviews it and makes sure that, hey, these documents they all look good to me. The numbers are right. At which point we sign, we send the funds from closing and hold all the documents. And then now going forward, that property that's been completed now, cash left his IRA, and now we have a holding in his account of this piece of real estate. Going forward then, all income from that property must come back into his IRA, so he can have his tenant simply write the check, send it to us for deposit. We'll put it into his account. Any expense for that property, the insurance, the maintenance, any repairs, all have to be paid by the IRA. And again, John, from our reading of the rules, John could be directing that activity. He hires the guy to paint the house. The painter gives him an invoice. He forwards it to us. We pay that bill out of his account. In this particular strategy, he rented the property. He got a net rent of about $1,200, and over a 2-year period, that's $28,000 back into his portfolio. So there's his cash flow. When he sells the property down the line, any amount he makes in the account, again, the appreciation, he bought it at a good price, he sold it at an increase and a gain in the profit. Whatever profits he makes, the cash flow plus the appreciation on sale, again, all comes back into his IRA with no tax consequence to John. He bought this property 100% inside the IRA. There was no leverage involved. There's no taxes involved. Now he has simply more money to move on to his next deal.
Yeah, this is the exact same situation that I was talking about in the very beginning when I purchased that property from that couple that were like my age, and they had like over $600,000 in their retirement account to purchase a property. Well, it's because they had done it over and over again, and they had all these huge profits in there that they had rolled in over the years, so that now they had a huge nest egg of resources in their retirement account that had never paid taxes and was continuing to grow and continuing to expand at an exponential rate. And that's why I love this strategy, using your retirement funds to get involved in real estate instead of just like investing in the stock market and being blindly invested in the stock market. This way, you're actually choosing your investments. You're selecting them.
Exactly. And again, even in this realm with real estate, again, you're choosing how you do it. John, he could have said, I'm not selling the property. I'm going to hold it for the next 10 years and continue to get $1,200 a month in rent. He also could have bought a house, fixed it up, and then gets an offer right away and sells it for an immediate profit. That you really, your strategy can be utilized however you wish, inside the account. One thing we've seen people do as well over the years is kind of joint venturing, maybe like on a rehab deal. So this case study, the client was Andrea, and she had cash in her IRA. She was one of those individuals, you meet at a REIA group who wants to be involved in real estate, but she's coming to the investor meeting after her 9-to-5 job. So she doesn't have time to go out and find a house and manage a rehab. She's got a regular job, but she's got the cash in the account that she wants to use towards real estate investing. And Steve was the investor who actually has the project. So Steve's looking for cash to flip a property, make a buck, but he's looking for a lender And again, Steve knows with the self-directed IRA, Andrea could provide that capital for him to do that deal. So it's kind of in talking, and when you're Andrea and you're lending money from your IRA, whatever terms go into that loan, when someone's looking to borrow money, that's really up to you and the borrower to come up with those terms. There is no set rate or set schedule that you have to charge, as we'll see on the next slide with the loan terms. But it's kind of like a joint venture, but in this particular case study, the client really structured it as a note and mortgage in how she did the deal. And if you look at the loan terms, she lent him $100,000. And on a rehab deal, most people would expect the interest rate to probably be 12 to 14%, right? If you're rehabbing a house and you're borrowing some hard money. But in this case, they structured the loan where it was only 5% interest on the funds, but there was an equity participation of a third of the profit. So a third of any profits that Steve made on the deal went back as part of the payoff to Andrea's loan. So that way she was kind of able to, to be involved in the rehab and get some of that upside as well, providing the funds. And again, they could have done this as an LLC. They could have done some kind of partnership agreement, but in this case, they just did it as a loan, and she gets her IRA got a first mortgage on the property. So, and again, at ADVANTA, we don't provide legal documents, so Andrea is going to have herself or an attorney prepare the note and the mortgage. Again, she's going to have to review and approve the note and mortgage and all of the terms. We're going to make sure, again, that her IRA is listed as the borrower, or I'm sorry, as the lender on the note that Steve is going to sign. And we're going to make sure that the terms that she's told us also are reflected in that document as well. Once the documents are approved, we wire money out of her account to the closing agent. They disperse it to Steve. He uses the money to buy the property, get it fixed up. And when he sells the property, in these kind of simple terms, simple numbers, there was a $30,000 profit. After all the closing costs, all the other expenses, he made $30,000 profit. So at the end of the day, her IRA account, she gets back her original principal. She got the monthly interest payments, and then she got a third of the profits back into her IRA as well. So she earned 12.5% on her $100,000 in 6 months, just from participating in the deal. And then from Steve's perspective, someone who didn't even have an IRA account still was able to utilize the self-directed IRA as a lending source. He didn't have to go to a bank and go through the, all that process to get a loan. And he still was able to make out with his profit at the end of the deal. So it's kind of a different way to invest in real estate. Someone either buying a rental property in the first example, or in this one, someone sitting a little bit more passive on the sidelines, but still being able to utilize their retirement account and earn interest. Again, not everybody out there, some of you on this call probably would love to go get your hands dirty and buy a rehab project or manage a rental property with tenants. And there are other people who would say, I don't want to be involved in that, but I'm more than happy to be the financier of a real estate deal and sit in that position basically as a bank with my IRA account.
Yeah, I've seen a lot of people do that and become really successful with it. And then they're getting all these gains and these returns, and they're not paying any taxes on it. So that's really beneficial. So some of this stuff is happening in less than a year. So normally that would be like your like earned income. So you're getting paid, you're paying taxes at like 35, max 35, 40%, but when you invest it with your IRA, you get to defer those taxes. And you don't have to, you can just keep rolling your money into the future. Yep.
And going back to the slide, so the terms here, the loan terms, again, Andrea is basically the bank. So if she said, I don't really know, I trust Steve, but, sometimes he doesn't always make a profit on his deal. So I'm more comfortable with just charging him that 12% interest and maybe a point or two up front on the loan. And I'll just take that and I'll be happy with that. She could do that. Or if she said, you know what, I think he usually does do well. And he usually makes a good profit. I don't want to just get 12% when he's making all this money on the flip. So I would like a piece of the action. So it's really the loan terms. That's why I've always thought private lending was so interesting in the self-directed space, because you're the bank, and all these terms are between you and the borrower to negotiate. And so you have a little bit more control, a little more flexibility. You can be more creative as well with those terms when you're structuring it. Kind of sticking in the passive realm, kind of our last case study is talking about investing like in a multifamily syndication.
Yeah, and this is specifically where I've invested all of my resources from retirement accounts in the multifamily syndications.
Yep. And so, investing in multifamily, I think, again, gives somebody who's a passive investor, an quote unquote easier way to invest without as much of a time commitment as buying a rental property. Again, some people are absolutely fine with a time commitment. They'd rather be in control. And with multifamily, with private lending, you are giving up a degree of control when you put your money in and somebody else has control over it. They're managing it. But we've seen probably in the last 4 to 5 years, just a huge increase in the amount of people investing in multifamily real estate. I said when I did transactions back my first 7 or 8 years at ADVANTA, I saw some here and there, but it wasn't a lot. But really over the last 4 or 5 years, just a huge increase on our side, and we've been been able to connect with some good players in the multifamily space as well. But in this example, John is again the one that has the cash in his IRA account. Jane is the one who's doing the syndication. She's got an offering. She's got a multifamily property under contract, looking for investors. So Jane is going to provide John. She gives him the subscription documents, the prospectus for the multifamily investment. And again, John opens up his account. We do a transfer form to have Vanguard transfer that money over into his account with us. We submit the form on his behalf. Again, as I talked about earlier, that's a tax-free movement of money from the Vanguard IRA to the ADVANTA account. So again, the investment process and kind of the familiar theme is that our role at ADVANTA is to make sure that whatever ownership documents are, whatever the investment documents are, that they're properly titled. In the first example, it was the deed and the closing documents. In the last example with Andrea, it was the note and mortgage was the actual investment. And in this case, when you're investing in multifamily, it's the subscription documents where your IRA is becoming the member. So again, we're going to want to make sure that the subscriber's name is the name of the IRA, that the tax ID number that is used is our trust tax ID number, not his individual social. So any tax reporting done by the syndication goes back to his IRA. And then again, ultimately, we're going to sign the documents. We're going to send the wire to fund the investment, and John's going to review and approve of it for us as well. And so with the multifamily deal going forward, he gets the preferred return each year back into his account. When the property, if it gets refinanced, he gets that lump sum payout. And all of that money is flowing back into his IRA account. I have a client in our Atlanta office who he calls it mailbox money. He's invested, I think, in like eight or nine different syndications. He goes, yeah, every month I just go online, make sure that check came in. And he's invested personally as well. So sometimes I just walk down to my mailbox at the first of the month, pull my checks out, go deposit them.
Exactly what it is. It is mailbox money. I mean, that's why we invest in real estate.
Yep, and he doesn't have to do. Yeah, with the syndication, he's not doing anything else. He's not worrying about filling the vacancies in any of the units. He's not worrying about the maintenance on it. He just isn't a passive investor. So again, it's a way for someone to still invest. Investing in real estate doesn't have to be what you see on HGTV, where you got to go in and knock the cabinets down and manage your tenants over. It can simply be writing a check and then sitting back. Now, again, we talked about the UBIT issue earlier in the UDFI tax. Again, if you're invested in multifamily and there's leverage involved, which there in most cases are, using your IRA can subject you to that tax. So you're going to have to ultimately look at the impact that tax is going to have on your rate of return. Again, solo 401ks, no UBIT tax on that investment income. So I will say, I always like to illustrate to people will say, oh, if this tax is going to apply, this UBIT tax applies, then why would I bother doing this in my IRA account? Like the whole point of this tax deferral and having to pay a tax, this is stupid now. Why am I going to do it? Well, if you have to, the thing with your IRA and your old 401k funds is you have to have that money invested somewhere, right? You don't want to just have it sitting in cash until you get to retirement. It's just not going to grow. You're losing to inflation every year. You have to invest that money somewhere, whether it's in stocks and bonds or whether it's in real estate or other alternative investments. So even if I'm investing in a multifamily project that's returning 16 to 17% a year on average, and even with paying UDFI tax, I'm returning 13 to 14% a year, is that still better, or do I feel more comfortable with that investment than having it in the stock market? So, UBIT tax is not always the big boogeyman that people make it out to be. I mean, it's a tax you impact, but then after that, you have the money going back in. If it's still a decent and healthy return, and something you feel more comfortable with, that's why people are certainly choosing to still make the investment either way.
So if you have a 401k at a separate company that you created at a separate, like when you were working for someone, right? And then you rolled it over into a new IRA. Can you create that new IRA as a solo 401k?
Yes and no. So the answer is you can. Now, the only thing the caveat on that is to have a solo 401k, you really do have to have kind of like your own business enterprise or even like a side business to do it. Now, if all you have is W-2 income, you work at a job, you don't do anything on the side, it's just, you working 9 to 5 or whatever the hours are each week, and you don't have a side business, it's kind of hard to create a solo 401k because you don't have a sponsoring business behind it. So the IRS expect that if you're going to establish a solo 401k, that you really have this other business, and that at some point you're going to be making contributions to that business from the income that you generate. So it doesn't have, for anyone who's self-employed, obviously that they qualify automatically for a solo K. If I do have a W-2 job, but on the side I do some little consulting work or I dabble in some real estate investments on the side, there's ways then to create a business structure that can then sponsor the solo 401k plan. So that's my only caveat. There are people out there, hey, everybody can have a solo 401k. I really think you need to be a little bit more discerning than that and make sure you kind of have a business that you could justify to the IRS for the solo K. It doesn't have to be profitable every year. You don't have to make contributions every year, but you do want to have kind of that backup when you started the solo K plan. But that's, again, somebody investing in leverage real estate deals. If you can create that, even just that side business to do it, it's going to be worth it to not worry about the UBIT tax.
Right. And then James asked another question. How does age play into self-directed? If a person is in their 70s, would it make sense to use this account?
Yeah. Yes. And we have clients who are definitely over the age of 70, even somebody over the age of 80 that are still self-directing. Now, the one thing where age comes into play, and I mentioned this kind of in passing earlier, is that with every IRA except the Roth, you have to, starting at age 72, take a required distribution from the account. So the IRS is, okay, the money's been tax deferred since you started the account. Now that you're 72, we want to start reaping some of that tax revenue back in. So at 72, you have to start taking a distribution that usually is around, say, 3 to 4% of your total value of your taxable IRA accounts. So that's something where I would say if you have IRA funds and you're over the age of 72, you don't want to place every dollar of your IRA account into an illiquid asset, like say a real estate syndication where your money's locked up for a number of years, or a deal where you can't just easily exit. But that's really the only restriction on age, is making sure that you have some liquidity at age 72, or you have enough cash flow coming back in to satisfy that required distribution. But you don't have to stop growing your account at 72. You can continue, grow. We have people who are growing their accounts at 10 and 12%. So their RMD, the required distribution, doesn't matter year to year. But that is one thing to consider at age 72, is just making sure that you have the ability to pull that required distribution.
Is there another alternative to that, or that's basically it?
Yeah, you have to take the money out at 72, that 3 to 4%. Now the cool thing, and what most clients do on our end, they're holding after age 72, they're holding, say, an interest in a private equity fund that is very illiquid, but they still have their IRA at Schwab or Fidelity. Your required distribution, you add the values of all your IRAs together, and then you can take the distribution amount from whichever account you wish. So a lot of our clients, they don't take the RMD from their illiquid investment with us. They just simply take a distribution from Schwab that satisfies it for all their accounts. And you can certainly do that every year. So it's been I've only seen it once or twice in 15 years where someone got into a situation where they had to try to liquidate or find some solution to the RMD issue. Otherwise, it's like I said, people have other places to pull it from, or they're getting cash flow on their investment through us anyway that satisfies their RMD for the year.
And Scott, Perry had a question. I also understand the interest on the loan you pay back to yourself doesn't impact your contribution limit. So I think that's from case study 2.
Right. So, and that's a good point. So any income that your IRA generates from the investment has no impact at all on the amount you can contribute out of pocket each year. So traditional and Roth IRAs, you can put in 6 or 7 grand a year. The SEP IRA, the solo 401k, you can put upwards of $58,000 a year. But that is all money coming from your pocket, from your own earned income. But if the IRA investment itself is generating in excess of that, that has no bearing on what you can contribute personally. It does not count against that annual limitation. So obviously, Oliver, that's why you saw the people that you bought the property from. You know, if they were limited to only 6 or 7 grand a year in gains, then they would have never gotten to where they were able to get to. Yeah. The gains in an IRA are unlimited. Yeah. It got when Mitt Romney ran for president back in, I think, 2012 it was. A lot was made about his Roth IRA. He had a Roth IRA in the, like 50 or 60 million, I think, because his IRA he had his Roth IRA taking positions in privately held companies that were poised to take off. Now, there might have been a little bit of inside information that he had to really go that far with it, but there was no restriction on it. The owners of Google did the same thing with Google shares before it went public. They held a large number of shares inside their Roth IRA. So they're able so the gains are unlimited. It's only your annual out-of-pocket contributions that have that limitation.
That's unreal. Because that Roth IRA is all tax-free because you've already paid taxes on that money. So that's
correct.
That's unreal.
Yep.
Appreciate you sharing that. And then Matt Conlon asked, does the UBIT tax apply to a SEP IRA?
The UBIT tax applies to every account except the solo 401k. Yep. So any IRA that is invested into leveraged real estate is going to have that impact. Now, I know for, again, the UBIT tax, people, it's kind of, again, like the boogeyman, oh no, UBIT. I know with syndications, I don't even think you even owe UBIT for the first 2 years or more, typically with a multifamily deal, because there's so much depreciation, other deductions, you don't even have to worry about it up front.
Yeah.
And even honestly,
like that's where people have the majority of their money. Like they have it in their retirement accounts, and then they have it in these retirement accounts in these highly volatile things. Mm-hmm. So like, I'm always like, take that money and put it into real estate. You have something that's security and it's stable, and it still grows at the same rates at 15+%, So like you get the best of both worlds. And like, even if you do have to pay a couple points with the UBIT tax, it's like, it's a no brainer still.
Yeah. Like I said, like if your alternative is to put it in the market and then watch, somebody's earnings come back negative, or, a war starts somewhere around the globe, all of a sudden the market tanks. I mean, that's your, or even the market's good, but you're not sure which fund to pick or which stock to pick. Instead, hey, I can just put my money here, and even after paying this tax, it's a consistent 12 to 13% a year. A lot of people will take that every day, rather than hoping for the market to go up 20% year to year, when they know that it's going to go up 20% this year, and then next year it's going to go down 7% or 10%, and it's going to be kind of a game. I heard an economist once at a convention I was at. I think the stock market, they always say like the stock market historically returns like 8 or 9%. It's kind of like the conventional wisdom, which is a pretty decent. It's a decent return year over year if you could do a consistent or 8 or 9%. But I think in the history of the stock market, since the late 19 teens or whatever it started, the number of years that the stock market has returned between that 8 and 10% mark was only 15% of the time. So other than 15 or 20% of the time, the market is either well above the 8 or 10%, or it's far below. It's not every year you just grow 8 to 10%. It's one year you're up 20%, the next year you're down 10, then you're up 10, and then you're down 20. And it's the average of when you get in, when you get out, that can make it more difficult in your timing. Definitely in 2008, when the market tanked, the real estate crisis, and then obviously that bled into the stock market. If somebody was hitting age 70 or 71, and they're like, hey, this is my retirement account, and this is what I'm going to be living on now, I'm retired, and the market tanks and your account gets cut in half in value, I mean, that's a huge impact to somebody who goes, wait, I thought the market returned 8 or 9%. Well, it does, except for on years when it doesn't, and you're in the wrong age bracket. So again, getting into something that's more consistent, kicking off a consistent cash flow, is really what self-direction is about. We have a number of clients who invest in either loans or real estate where they get that $1,500 check each month from their investment. It goes into their account with us, and they turn around and have us send them $1,000 a month to live off of or to use for their retirement. It kind of is consistently paying dividend.
Yeah, I appreciate you bringing that up, Scott, and digging into that.
Yep.
That was a good one.
Yeah, well, that was kind of the end of my case today. I would say if you're interested in learning more, I mean, we delved into a lot of areas today. We can certainly go deeper on a number of topics. We do a lot of events, nothing live currently, or nothing in person, I should say, right now. We do a number of live webinars. We usually do 1 or 2 a week on different topics. This past week, we had somebody talking about short-term rental opportunities. I was at a CPA on last Tuesday talking about real estate tax tips for investors. So we do a lot of education from that perspective with different speakers and different industries. And all of those webinars that we do are on our video library. So you can shoot me an email, I'll add you to our list, and you'll get those invitations to those upcoming webinars.
So Scott, I actually had my one of my cousins reach out and say, how do I get access to you? So you have a slide with your contact information again?
Yep. Let me jump there. So getting started is, I'll get there in just a second, but getting started, opening your account takes 15, 20 minutes. Funding it, transferring money, rolling over can take anywhere from a few days to a few weeks, depending on the type of funds it's coming from or the custodian. And then obviously start investing. Tell us, and a lot of clients come to us at step 3. I just came across a multifamily investment opportunity. I was told I could use my IRA to do it. How do I get started? So they go from step 3 and then go all the way back to 1 and 2 to get it put in motion. So again, it doesn't take long. It's very easy to do. Here's my contact information. So, again, shoot me an email. Just say, hey, I heard you at Oliver's meeting the other day. I'll just add you to our database. We don't, we're not soliciting you for anything. All you'll just get is invitations to each webinar that we do. Most of our webinars are 12 to 1 Eastern time. If you can't make it one day, sign up for it. Because what we'll do is you sign up. When we're done with the webinar, we send the recording out to everybody who were registered. If you're interested in networking and buying and selling assets, just about every other Friday, our next one is coming up is next Friday. We do an event called Pitch, Promote, and Prosper, where it's a Zoom session just like this. We give everybody a few minutes to introduce themselves and anything they're looking to buy, sell, and network with, which is kind of unique in our investment community. Again, we're not approving or disapproving of any investment on that platform, but merely just providing a place for people with self-directed IRAs or personal funds, whatever. It doesn't matter. It doesn't have to have an IRA to be a part of that group. But we'd encourage you to attend those as well. And again, everything's free to attend. Just email me to get on our list, then sign up as you wish.
Yeah, Scott, I really appreciate you coming on. I mean, I love all these different strategies. I always say I used to wish I had people I could talk real estate with, talk different strategies with in the morning. And instead of just saying that, I finally went out there and found the people. And it's awesome that you were able to come on and share your strategies for how you can get invested in real estate and have control over your retirement dollars and really explode and expand on your portfolio based off of decisions that you're specifically making and not someone making those decisions for you. So I appreciate your time and I appreciate all the value you've gotten. Anybody got any value from Scott or have any final questions? Let's thank Scott. We got a bunch of thank you. Perry's like, this was great. Thanks, Scott. Brian was like, thanks, Scott. Great info. So really appreciate you, Scott. This is really
thank you. Appreciate it. And yeah, I appreciate you having me on. And anyone who has any further questions, I always say we do these presentations. It is generic in the sense I'm kind of just giving you a general overview. Everybody has their own unique situation, their own unique account type, their own unique investment type. We talk about those prohibited transaction rules and disqualified persons. Someone might want to explore an angle on that and see if there's a way to kind of sneak by that rule or skirt the rule and be okay. Call me. I'm happy to walk through your scenario, tell you what's needed, what you can, what you can't do. If I can't give you a definitive answer because it gets into that legal or tax realm, I'll give you the name of a CPA or an attorney who might be able to help you determine that. So I'm always available. Free consultations, call, email, anytime you want, and I'm happy to answer for you. And certainly, again, thanks Oliver again for having me on this morning.
Appreciate you, Scott. And Eduardo says thank you. Matt says thank you. Really appreciate you, man. So I appreciate all the value and you pouring into us this morning. So
Awesome.
All right.
Thanks again. Thanks everybody for getting up this morning and participating as well.
Yeah. Awesome. Melissa's saying thank you too now. So again, I appreciate everybody. Let's crush it. Let's continue to do big stuff together. Hey there. I hope you enjoyed the video. If you did, please click subscribe down below and give me a thumbs up. You can reach out to me on Instagram or Facebook at Oliver Fernandez 3. I have new videos just like this one dropping every week. So drop a comment down below and let me know what you want to hear next. Until then, keep growing and keep learning. Just do it.